Two founders, same idea, same budget. One raised $5 million, burned it in 13 months, and had to lay off their entire team. The other bootstrapped, nailed these 4 numbers, and had investors chasing them. Why? Because one knew these 4 numbers and the other didn't. This isn't just accounting, survival. Let's break down the 4 numbers that decide whether your startup thrives or flatlines. And one bonus number at the end that most founders don't track, but should. First up, EBITDA, earnings before interest, taxes, depreciation, and amortization. EBITDA is a measure of a company's operating performance. It excludes the effects of financing and accounting decisions and shows your true profit from business operations. Think of it like wiping the fog off your financial windshield. Suddenly, you can actually see what's working. It strips away noise, so you can focus on what really matters. Is this business model working? Netflix ran at a negative EBITDA for years while investing in original content. By Q1 2025, Netflix reported $7.25 billion in EBITDA. Elior Group, a European catering company, flipped from negative EBITDA to 167 million euros in 2 years by cutting bad contracts and tightening ops. Founders tip: track it monthly, compare it with others, aim for positive EBITDA within 18 to 24 months of scaling. Next, free cash flow, or FCF. Free cash flow is the cash left over after your company pays for operating expenses and capital expenditures. It's the money you actually keep. If EBITDA tells you you're making money, FCF tells you if you actually get to keep any. You can't scale if you can't breathe. Cash flow keeps you alive. Apple had $99.6 billion in FCF in 2023. They use it to invest, buy back stock, and dominate new markets. Stripe raised $6.5 billion in 2023, but they were already cash flow positive. The funding was a weapon, not a lifeline. Founders tip: track FCF monthly. Use it to fund growth, not just survival. Quick sidebar: what's burn rate? Burn rate is the amount of cash your startup spends each month. Gross burn equals total expenses. Net burn equals expenses minus revenue. If your net burn is $50,000 and you have $500K in the bank, you have 10 months of runway. Runway means how long can your company operate before running out of cash. Modern cautionary tale: Quibi raised nearly $2 billion, but with sky-high burn and no audience loyalty, it shut down in less than 8 months. Founders tip: track burn and free cash flow. One tells you how fast you're spending. The other tells you how much you're keeping. Next up, CAC, customer acquisition cost. CAC is the average amount you spend to acquire a single customer, including ads, tools, salaries, commissions, and overhead. Pause for a second. If you had to spend $300 to convince someone to pay you $30, how long would you last? If CAC is too high, you're spending more to gain customers than they're worth. Dropbox's CAC was $388 after launching its viral referral program. Give 500 megabytes, get 500 megabytes. That cost dropped to $68. Their strategy turned users into a self-replicating growth engine. Instead of relying solely on paid ads, they used incentivized virality to lower costs and explode adoption. Liquid Death built brand loyalty and reduced CAC using memes and community. Real founder mini case. Ben, a founder in Austin, was spending $92 to get a $29 customer. He pivoted his messaging, added a freemium model, and watched CAC drop by half in 6 weeks. Founders tip: break down CAC by channel. Track it like your business depends on it, because it does. Now flip CAC on its head with LTV, lifetime value. LTV is the total revenue you earn from a customer over the entire relationship. Imagine planting a seed that keeps giving fruit for years. That's LTV. LTV must be higher than CAC, or you're scaling losses. Aim for an LTV-CAC ratio of at least 3 to 1. The LTV-CAC ratio compares the revenue from a customer to the cost of acquiring them. Above 3 to 1, you're efficient. Below 1.5 to 1, you've got a problem. Netflix users stay for years. One $15 a month subscriber may generate $500+ over time. Amazon Prime users buy 4 times more than non-members. That's long-term value in action. Founders tip: boost LTV by improving retention, offering upsells, and personalizing the experience. One more bonus: unit economics. This is the revenue and cost tied to a single customer or unit. It tells you whether you're making or losing money with each transaction. If your LTV is $200 and CAC is $50, you're winning. If it's reversed, you're scaling failure. Let's recap. EBITDA, your clean operating profit. FCF, how much cash you actually keep. CAC, what it costs to win a customer. LTV, what that customer is worth long term. Master these, and you're not just running a startup, you're building a machine. Because money doesn't follow effort, it follows clarity. Drop a comment. Which of these 4 numbers are you tracking? Hit like and subscribe.